Good Saturday morning to you, everybody, and welcome to On the Mark, along with Mark Papa. I'm Gary Byron. You can check out Mark's website with Financial Resources Group. It's simple. You take financial resources, right? It's www.frplan.com. It's that simple. By the way, when you're on frplan.com, look for a link that'll take you to YouTube, and there's a reason why. See, Mark's got his own YouTube channel. All you need to do is type into the search field Mark Papa, MarkPappa 5207. Mark Papa 5207. And then you will get this show, as well as any of the previous episodes that maybe you have missed or would like a replay on. You can also schedule a no-obligation consultation. And let me tell you, it's very thorough, and you're going to walk away learning something. Even if you already have a financial advisor, there's a checklist. You can get a gift card. There's a whole bunch of things going on. Write this phone number down. More importantly, give it a call. You can give it a call right after this show. You can give it a call Monday. You can give it a call anytime during the week. Just make sure that you call him. And he's not pushy. There's no obligation at all. In fact, if anything, it'll open up your eyes. 860-657-8380. 860-657-8380. Mark, good morning. I see you still have that cold from last week, but you're a little better. I hope you're doing well.
Yeah, it's definitely it goes away and then came back a little bit on me, but
you know what it is? You're just run down, and you mentioned something I think last week about taking a vacation. Tax season's over. I know that's your side gig. Yeah. I'm kind of bittersweet on vacations myself because
it's all consuming.
When you come back, you just got double the work to do, and who likes that? But you know what? You needed to recharge the batteries, and I think it would actually, it would probably do you very well.
Oh, absolutely. And then it is
warmer weather, though.
Yeah, it's definitely a great benefit. It takes about 3 weeks for you to get back to normal. Your brain gets so compressed after that long season that it actually gets just to normalize, just to get back to yourself.
You run down.
You're run down. You're mentally. Your brain is like encrypted. It's like, it's just ridiculous. It goes in one direction for so long, and then all of a sudden you realize, okay, my phone's not ringing so much. I can kind of calm down a little bit. And then, we start setting appointments with our clients too before summer to do their financial reviews and their annual reviews. Because
there's a lot to be said for that. Mental health is so, it's not talked about much. Everybody talks about their physical health, and make no mistake about it. That's important. But mental health, I think we've got an epidemic really going on with mental health on many different levels.
I couldn't agree with you more on that. I've actually seen people who I've seen them decline, or struggle with it, and we, instead of pointing fingers, we just need to offer those folks help and find them a path to get their mental health in order, even if they have to speak with a therapist or whatever the case may be. But they've got to get that
something
get that taken care of, and that's something that as our country, if you look at the homeless population, some of the other things out there, but I also want to kind of segue that into when I talk about mental health is. Aside from people who suffer from depression, anxiety, whatever else might be out there, let's talk about cognitive decline, where we tend to get older, right? We're not as sharp. We tend to be a little bit more forgetful. And I am very well trained at this, and I've seen it happen to people in my tax business and in my financial planning business. People that were just really sharp on the ball. They start getting a little bit forgetful, and then another year goes by, and they're more forgetful, and then before you know it,
dementia sets in.
The dementia sets in, and they are beyond just not only forgetful. They can't, they really need. Remember I talked about that power of attorney. They need
a couple months ago,
durable power of attorney to kind of bring them in and help them manage their finances.
So maybe we'll start with an overview then of long-term care costs in Connecticut in comparison to other states. Yeah. There's some data out there that I think that you've accumulated. How does Connecticut compare to other states with long-term care costs?
Well, not so good, Gary. That's a common answer.
I probably just opened up Pandora's box, huh?
Well, and that's the thing. So before you know it, I can't tell you how many times, as advisors, we bring the long-term care, how are you going to pay for it, into the equation if the event you needed it. And we get a lot of funny answers. And some people says, well, my wife's going to take me in the backyard. I told her, and to take me in the backyard and shoot me. We hear all sorts of funny answers because no one wants to talk about this problem. And, I have a good friend of mine who he actually has an insurance agency in West Hartford. And he knows long-term care inside and out. He's a wonderful guy. And he would tell me, Mark, look, unless somebody has been through it, taken care of a parent, changed the diapers, done the cleaning, taking care of them, taking time off of work, billions of dollars are lost every single year in unpaid caregiving. And at a certain point, you just can't do it anymore. An individual person can't do it. So you need a professional. You're going to need professional help. You're going to need some type of care, okay? We're all going to need it eventually. It's a 50-50 shot. But that's a pretty high probability. If you told me, hey, Mark, 50-50, you double your money, or 50-50, you die broke, what would you do? Would you even roll the dice, or can you prepare ahead? So I want to just get people to understand that it isn't something like long-term care insurance, what they may think is those old traditional policies and I've seen people also pay into those policies, and it was nursing home only. Well, they never made it to the nursing home. They needed home in home. They never made it to the nursing home, so the policy never paid.
I hear that long-term care, well, you said you 50-50. You buy the policy. There's a 50% chance you'll never need it. And that's not just a few dollars extra. I mean, I'm hearing it's a significant amount of money. Yeah. And a lot of people at 30 years old, when they just start a family, they get life insurance. They're not even thinking about long-term care for themselves. They're just trying to make ends meet with their new family. Mm-hmm. So they're not buying that policy at 30, when they should. They're getting into the game late. That affects the cost as well, I would imagine.
Yeah, absolutely. I think you don't even think about it till like maybe your mid-50s, and if you need to have extra money in order to pay for it. So like the traditional long-term care policies, nothing against them, and if you do, and I have clients that are actually on claim right now they have awesome long-term care policies. They're like the kingpins in the nursing home. They've got everything's taken care of. The bills are being paid. They're not spending down or burning down their own money. But I want you to think about it. Going back to your question, Gary, which I apologize for not answering a little bit more directly, but the national average for a private room is about $9,000 a month.
A month?
$9,000 a month. In Connecticut, that can easily exceed $12,000.
Well, that's quite a difference. I mean, so how do costs compare, let's say, for other types of care, such as assisted living or home care, aging in place? That's popular.
Yeah, well, assisted living, the national average is about $45 a month in Connecticut. That can rise to about $6,000 or more. And then home care services, there's more people do want to age at home and stay at home as long as you can. You might have it might be like $25 an hour for like a companion. And it all starts out with that. It starts off with a companion. And then before you know it, it starts off to, it gravitates towards needing real full-time care, But I mean, there's a point in time where, it's hard to actually, how do you, move somebody that, if God forbid, they're so fragile, they can break a hip.
But it's higher in Connecticut is my point. Just because the cost of living, everything's more expensive in Connecticut.
It's the cost of living, the cost of labor. I'd imagine it is not being a CNA, I think they call them, is not a fun job. It's a very difficult job. It's hard to find people. And true. I mean, think about it.
It's not for everybody. Not everybody can do it.
It's not for everybody. So, but going back to that, there were also other programs in the state of Connecticut. You have the Connecticut Home Care Program for Elders, which is called CHCPE, which allows for people to be taken care of. And I think the bottom of the barrel, which is kind of terrible to say it that way, but is Medicaid. And Medicaid is also. It's no picnic. It basically means you've had to spend down all your money before you can qualify. And then what happens if you're married? You have your whoever the spouse that is the healthy spouse who's not on care on the long-term care becomes what's called the community spouse, and there's an allowance called the CSRA, which is Community Spouse Resource Allowance. That means that all they're really able to keep is a maximum of $157,920. So between 50 and 157,920. That, I'm sorry to say, I don't know any retiree that can get by on $157,000.
No.
And, you know, so Medicare is not your best option. Medicaid is not, and a lot of people think, oh, Medicaid's going to take good care of me. But you know what? You're going to give up everything that you worked your entire life and all your savings. And I've seen it get wiped out. I've seen $1.3 million, $1 million get wiped out and go right to the nursing home.
So with these high costs, well, really, I don't know, what options do retirees have in order to pay for long-term care?
There are more than just the traditional long-term care policies that people think that, again, I could use it, I use it or lose it. There's several other options, actually, and the insurance industry has gotten to be very innovative in how they do this. And let's face it, let's say you had $100,000 in a CD earning you 5%, or you think you can put your money in the stock market, and that's all great. But what happens if you have a bad year like we just did, and you go on a long-term care claim and the market's down and we're in a bear market, we're down 20%. Now you're locking in losses. So your $1 million nest egg just went to 800,000. Oh, and now but you have to start spending it on long-term care. How quickly and how fast can that get burned down? Wow. So the timing isn't always great. So there are products out there for people to consider. And I can't get into too many specifics on the radio, Gary, but there are some that are really really
then
awesome.
Let me ask you in a different way.
You don't lose the money if you don't use it for long-term care. You get to keep the money.
Okay.
So if it's either one or two things. I have a bucket of money here that's either there to pay for long-term care, all right? And in certain cases that they'll give you, there's one company where you put your money in and you grow it, do your best to grow it. If you need the money, you could spend it. But if you don't need it and you want to keep it for long-term care, when you go on claim, they'll actually triple your the amount of benefit that you have. So you can get a double of it or a triple. And frankly, there's no stock market that you're going to pick, guru you're going to pick that's going to be able to do that for you. But you're paying for that. I mean, there is a cost to it, but at least it's not like you're paying those expensive monthly premiums.
What about like state-specific programs here in Connecticut that maybe retirees are not even aware of that even exists? Do you know of any?
Well, that was the one I just mentioned. Previously.
But what is that? What is that called?
Well, it was where was that acronym here? I just lost.
Oh,
it.
That's all right. Is it the CSRA?
Yeah, the CSRA. So that's like a program that the state will actually pay your.
All right. So careful planning then is essential. So then maybe offer some advice that you would give to some retirees in order to prepare for these potential costs.
Okay. Well, and again, the way people used to do this stuff, you can do it. Well, there's a legal way too, but I think it's a combination of everything. I like to build a moat. Okay, when I do anything in my life, I build a moat around the problem. Let's make sure that it can't come back and get me. So I think setting some money aside or figuring out what assets that you have that you would use for long-term care is the first step. Could you say if you needed it, what money would you spend first? And that's the question we get when we ask folks that question, they don't know the answer. Where would I get it first? You're going to get it from your IRA. You're going to get it from your brokerage account. How much money do you actually save? And, if you did have to spend that money, again, going back to your spouse, you're going to leave your spouse impoverished while you sit in a nursing home. And no one wants to do that. Now, in addition, if you do go to the Medicaid route, now you have a home that's fully paid. All right, you paid the mortgage off. You burnt that thing years ago. Now you have a house that you paid $30,000 for. Right now it's worth $300,000. So if you do a quick claim deed, right, and then you have a 5-year look back. So after 5 years, the state can't go after that quick claim. What ends up happening is your kids will then inherit your house at a $30,000 cost basis. Now you have to sell the house. Now they're going to get a $270,000 capital gain when they could have, if you just planned ahead, could have inherited the home at a stepped-up basis of $300,000, paid it, right, and sold it and walked away with the money. So instead of paying a big tax bill. So that's not a good way to go. I would say that find a way to, find that bucket of money that's not, even if it's a little bit, even if it's 50,000, just to take the edge off, because anything that you do to protect against long-term care is really going to help insure your other retirement assets. Let the insurance company pay that. And again, I know it's expensive, but what does it cost? $12,000 a month. So if it's costing you even I brought an example where it's a life insurance policy that doubles for long-term care. So it'll pay for, anywhere between 2 to 6 years. And if you die, you get the death benefit. Okay. If you want the money back, they'll give it to you. You can walk away. Or if you need it for long-term care, you can get up to, it'll pay you up to 6 years for long-term care insurance. But that money, even if it was paying you $6,000 a month, that's half the nursing home bill, 50% of the bill, which isn't. And you're not talking about putting up a lot of money. You're talking maybe, it's a lot of money, but $100,000 to start, or you can do it over, $10,000 a year, and then at the end of 10 years, you'll have a nice cushion for yourself. And again, if you pass away, it goes to your spouse tax-free. And if you use it, you get to use it for long-term care purposes.
But it wasn't $100,000 or $200,000. It's not going to get you far. How many years?
It's better than putting it in a CD, right? Or putting it in a money market fund. It'll, because that money will be gone in what? That's less than a year.
Look, this is all valuable info.
Yeah.
And it's clear that understanding long-term care costs and options can really significantly impact retirees' financial health. So,
oh yeah,
I appreciate all this, folks. You are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark Papa is from Financial Resources Group. You can find them online at www.frplan.com. That's frplan.com. Write this phone number down, and better yet, use it. 860-657-8380. Again, 860-657-8380. I'll repeat that. I'll give you a YouTube channel, too, that Mark has, more towards the end of the show. I know that there's a lot of misconceptions about long-term care insurance that can lead to confusion or some misinformed decisions. Can you give us a few of them?
Yeah, I just think, people read articles or they might hear from a friend or, there are some horror stories that the unfortunate side of things can happen. And I've had a situation where one of my clients actually was working. She was an employee at one of the major insurance companies of all places. And she had put money in her policy for many, many years. And there's a 90-day wait, so she didn't make the 90 days, so she never got to use the insurance. But there also was no way to get her reimbursed. So that's kind of scary. So those are the horror stories people are hearing. Those are the old policies. That's, I think, yesteryear.
Sure.
Right now, they have many other options that you can use. So they have, for example, like I mentioned, that life policy, right? So someone who had you have to have a decent income. Unfortunately, if you have a $500,000 retirement, chances are you're not going to afford long-term care. But if you do, if you are, have more money, then you have the ability to obviously pay out of pocket, but you also have the ability to buy the insurance. So I brought an example for a 63-year-old male who's a business owner, and he and his wife can actually pay themselves through their business and get and get a small deduction. Okay, on the long-term care component only, which is really awesome. So they get a big tax break. This is if you're self-employed. And then what happens if they apply as a couple, they get couples discounts. So I'm saying to them, why don't you both, you have this business that would have to be liquidated, right? And what happens if it got sold at the wrong time so that you can pay for your long-term? You can't work here anymore either, so what's the business going to be worth? But let's get something that helps protect you. So what we're going to do is we'll say, okay, well, you're going to take $10,000 a year, put it towards the policy. In year one, you have $5,182 towards your long-term care. But chances are we know we're not going to need it right away.
All right.
So at age 85, the same policy gives them $9,929 in total long-term care insurance. So it's, again, you're just letting you're basically just prepaying essentially, right? You slowly but surely.
And if you don't use it, if you don't need it, your spouse, you said, is getting that money back, or you're getting that money back.
Yeah, when if you pass away and you don't use it, it becomes a death benefit. So 124,000, 124,362 is the exact illustration, would go to the spouse, tax free. So she would be able to cash it in as a life policy, basically. So it's not a bad deal if you look at it, because you're getting your money back, but you had it there to protect you. Again, you have your $1 million retirement. That can get wiped out really quickly. And again, I've seen it happen. What happens when both spouses go on claim? And
but there are people listening right now. It's $1 million value, but I mean, who has the money for that? $1 million value. I mean, how it's $1 million policy?
Oh no, I'm saying your $1 million retirement. So someone with $1 million saved.
Oh, I thought you meant specifically for long-term care.
Oh no, in this case, you're putting probably $100,000 into the policy over time, and
for long-term care.
Yeah, and it grows. But then
and how many years does that give you, though?
It can give you up to 6 years, depending on what you choose. So you can have up to 6 years. We tend to when I do plan for this, I do try and plan for the longest amount of time for people. Because we're all living longer. I think men, we go a lot quicker than the women. Women last longer. They live longer and they last longer in nursing homes. They are just tougher.
I mean, does it matter if you're a smoker, if you're a consumer of alcohol, a frequent consumer of alcohol, or?
Yeah. Well, actually, that's a good question because
pre-existing conditions, I would imagine, has everything
certain
to do
conditions,
with the cost
absolutely.
of this.
In fact, what I did is I brought a questionnaire with me from one of the companies that we work with.
Oh, yeah, you did.
And they want you to they do ask you a bunch of questions. For example, are you currently in a nursing facility? Well, that's the obvious one. Do you have home health care services or adult daycare? Do you use a walker? Do you have a wheelchair? Do you have a multi-pronged cane? And I was told a regular cane is okay in one case, but if you have a multi-pronged cane, they actually take a harder look at you and can possibly decline you for the product because you're already pretty much going to need some kind of care in some way. Then there's, they want to know your medications, right? And they're going to ask you, do you have Alzheimer's? Do you have recurring memory loss? Do you have organic brain syndrome, mental incapacity? Multiple sclerosis, Parkinson's, paralysis, organ transplant. So they do ask you a whole bunch of questions, and not everybody's going to qualify for it.
Yeah, that's a concern for some people.
Yeah, absolutely. And then there's other things. I mean, they do ask you about leukemia, alcohol or drug use or dependency, blood clotting. I mean, there's a lot of questions you need to answer in order to qualify for this stuff.
Are these typical questions that you would ask when somebody were to sit down with you and discuss long-term care?
Yeah, you unfortunately, you have to pass some. Some companies are a little bit more strict than others, but then obviously, the ones that they're offering probably a little bit better benefits. So, the better the benefit, the more questions they're going to ask. They want to make sure that they're taking a risk too. And they want to make sure that they can take care of you at the same time. But they're also taking a risk that, hey, they're going to have to start paying you. And that's not the insurance company's game, right? The insurance company's game is not to pay you or to make sure you stay well and don't have any problems. But because the minute you do have a problem, they're going to start paying.
How much does this coverage can potentially add? This is already in addition to your retirement. If you opt for long-term care coverage, how much more are we looking at to put away in your retirement?
Well, let's think about this. I'll give you the equivalent. Okay, the equivalent is approximately. You're looking at somewhere in the neighborhood. Like I said, you put 124,000 in, and in this case, it's the equivalent of having $400,000 basically. When you add up all the payments over time. Mm-hmm. So it's really not a physical $400,000, but when you look at all the payouts that would have to come up, it's like having a bucket of $400 that you'd be spending. So, a lot of these policies will, just pay out their monthly. They'll pay out the monthly rate for the 6 years and call it a day, but it adds up to a lot, and again, they're keeping your money for 10 years. So obviously you're putting your money in, but the insurance company's taking your money, reinvesting it with the hope that they're going to make a greater rate of return on your money versus what it's going to cost to pay you out.
What's the average age that somebody starts to inquire about this? I bet they're late. They're late to the table, aren't they?
I would say, yeah, most people will probably start talking about it when they retire, which is a little bit too late. I would say
if they came to you at 50, 55, let's say.
55 is the perfect age for it. I would say that's about the sweet spot. Most long-term care experts will tell you that's about the right time to do it. A real long-term care person will tell you it's never too late to start.
Well, I know that. They would say that. Yeah.
And it's just hard to get, people. You're at different phases of your life. People have different priorities, and then the hard part is, let's think about this. We have to pay for college, right, for our kids. Got to get them through that. Then we have to be, a lot of times you can't fully fund your retirement and pay for college at the same time. And then once you're done with that, your kid's out of college. You have weddings, right? You have there's always
something,
reason.
Isn't there?
Right. So you have to. That's why it's so important to get to know your clients and plan properly.
Mm-hmm. All the more reason why we need to be sitting down with you as far in advance as possible. And folks, by the way, that's what I'm going to help you do right now. In fact, let me just say this first, though, because I promised you this a little while ago. If you missed any portion of this show or any other previous episodes, Mark Papa has his own YouTube channel, which you can connect to in a couple ways. You can go right to YouTube, and then in the search field, type in Mark Papa, MarkPappa, 5207. Mark Papa 5207, and you'll get to his YouTube channel. Or you can go to Mark's website, which is www.frplan.com. FR stands for Financial Resources, because he is with Financial Resources Group. So it's www.frplan.com. And then you'll find a link right to the YouTube channel. But there's also a lot of information on Financial Resources Group. What I would strongly suggest is to schedule a no-obligation consultation. He's going to open up your eyes. You could do this checklist that he's got. And get yourself a $100 gift card as well. Call him at 860-657-8380. I'll repeat that one more time. 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next weekend, have a good one, everybody. So long.